right, what's going on? Welcome back to the channel. Welcome back to another live stream. Yeah, I'm going to give it a couple minutes and then we are going to jump on into it. If you guys are here, hit me up in the comments, say hi. And yeah, we'll go. Kind of put this together a little bit last minute. Threw a question out to the Discord community to see if there were any topics anybody wanted me to discuss, and somebody kind of brought up just my overall investment philosophy, so I thought that might be a little bit fun to discuss. So that's what we're going to do today. And yeah, we'll see how it goes. If you guys have questions or anything, post them in the live chat. I will try to get to them. If not, it'll just be me talking and hopefully somebody out there listening. But if not, that's fine too. Let me see. I'm going to actually check the stream on my phone real quick just to make sure everything is decent. Dun, dun, dun. I think we're good. Hopefully we're good. Hopefully. But all right. So, yeah, the question I got, and I'll just kind of summarize it here for you guys so you know what this was kind of brought up for. But so the question was kind of overall investment strategy, ETF versus individual stocks, monthly or any frequency of contributions to your portfolio, etc. So that kind of got me thinking, and I've never really talked about just my background, like how I got into investing and whatnot. So I figured, you know what? Today is as good a day as any, and we're going to discuss that. And I got a pretty chart up here of the SPY to start us off. So my background, I became interested in investing probably in high school. And mostly it was like reading about mutual funds, index funds, things like that. And then kind of how that has evolved over my life has been into several different stages. And I kind of got the stages where I would say, and I put them in the description here, but the first primary focus is probably going to be income and spending, right? And try to grow your income to a point where you can take that excess income that is above your spending habits and invest that into the market, right? So, because what we're really talking about here, and I should preface all of this with none of this is financial advice. It's just my opinion. It's just kind of what I have done. And yeah, not financial advice, entertainment purposes only. Your situation, your tax situations, all of that stuff is going to vary. So yeah, if you're looking for financial advice, go see a professional and not somebody on YouTube. So there you go. Or at least do your own research and do what is right for your specific situation. So basically, probably the first 5 years or so, I would say like early 20s, I was really focused on getting my income up. And I kind of talked about this in previous videos. And there's a video out there titled, I think it's like trying to beat the market, you will fail, like most likely or something like that. But I kind of went over like income, index investing, individual stock investing, and different type of scenarios as far as income, spending, income growth, and investment growth. And really what we're talking about here when it boils down to it is just wealth accumulation. That's really what it boils down to. And there's a couple of factors of that, right? There's your income, there's your spending, there's what you have left to invest or save, and the rate of return that you get on your investments and how long you do that for, and for how long you get those returns. So at my core, like I have always been a US total stock market index investor. That has been the vast majority, probably for the first 6 years or so. Mostly individual stock, or not an individual stock, but total US stock market index fund, specifically VTI. That was kind of my choice. And I was of the opinion, and I still am, that during that time of my life, my energy was more better spent on like growing my income, growing my career, spending on or looking at my spending, seeing how I can get my spending down, increase my income, increase my savings rate or the amount of capital that I have on a monthly or yearly basis to invest, and to just invest that capital in something like the S&P 500 or total stock market US index fund like VTI. And really what VTI gets you is just a little bit of small cap and mid cap exposure compared to S&P 500. So that's pretty much probably what I did for the first 6 years, like I said. And really it was all about growing my income, trying to control my spending. And, it was obviously, also a team effort because I was married pretty much this whole time from the early stages. So it was a lot of balancing um, dual income growth and where we were going to invest that money. And at times it was invested in certain accounts that were accessible for maybe like a house down payment or something like that. And other times it was more of a focus on retirement accounts. So early on is probably heavily focused in Roth, so we could access that for down payment on house, our first house, and then also taxable brokerage. And then after that, it was pretty heavy focus on retirement accounts and taking tax advantage accounts like full advantage of tax account advantage accounts. So we did that for a pretty long time. I don't know, several years. Well, up until now, really. If we could max out our tax advantage accounts, we would do that. And eventually, it's kind of like shifted now to where we're like, okay, like our tax advantage accounts are good. So potentially, what we are going to be focusing on now is like taxable accounts, right? Having a better diversification of assets in different accounts that are accessible before retirement. So, and honestly, if I went back, I might have done a little bit more investments into taxable accounts sooner because it's just easier to access those. Depending on how active you are in those accounts, they can still be pretty advantageous from a tax perspective if it's mostly long-term capital gains, and you control when you're taking those capital gains, especially in something like a broad market index fund where you're just not really ever trying to time the market, but just accumulate. So something I might have done different is spread that out a little bit more evenly, because I think we're about 90% retirement accounts right now. And by retirement accounts, I'm like pretty much anything that's tax advantage, like a Roth IRA, traditional IRA, 401k, 403b. That's kind of what I'm referring to. With about 10 or 12%, something like that in regular brokerage accounts. So now it's kind of like we can essentially focus more on building up those regular brokerage accounts if we want to, but on the other side, it's the ability to tax shelter a lot of income when especially in your higher earning years. So like it is kind of like it does make me question if we hit the tax advantage accounts too hard too quick, but it's kind of like in the end it's going to be fine, right? It's going to be fine. So my biggest philosophy with investing has just been low cost index funds being able to increase the amount that I'm putting away into those index funds and prioritizing tax deferred accounts, tax advantage accounts. So a lot of and that's honestly still what we do. We're getting to the point where it's like the return on savings on taxes is pretty significant from just doing tax advantage accounts. So try to take advantage of that, and then once we max those out, essentially go beyond and start going into taxable brokerage accounts and accounts that we can access pretty much at any time. So the biggest thing that I want to point out from that is that when you're looking at like investing of philosophy, before you even get to an investing philosophy, you have to have like a an income, uh, kind of like an income producing and a wealth accumulation mindset, right? If you don't have the capital to invest and you don't have the income and the controlled spending to be able to take that capital and to invest it on a constant basis, then investing philosophy doesn't really matter that much, right? That's your firepower. So um, my first kind of main point with investing philosophy is really around income growth, spending control, and being able to utilize that capital into income producing or growth producing assets. And from there, I think about like, I don't know, 6 or 7 years after I started dabbling in individual stocks, made some nice mistakes here and there, and lost some money here and there, and then started developing luckily with a controlled, amount, relatively small to our portfolio, but started developing more of a philosophy around valuation, around how I analyze companies, quantitative and qualitative aspects of companies. And regarding we'll get that into that in a little bit. To kind of cap off this last, what I was previously talking about, what we always prioritized every year was basically maxing out those tax advantage accounts first, and then rolling into a taxable brokerage. So as far as like how much, because I know that's what the question asked in the Discord, like how much at what frequency. It was pretty much, never a really super set amount. It was just as much as we thought we could do. We would bump up our 401ks and whatnot, try to get those maxed out as soon as possible, and then have increased cash flow throughout the year. But it took like years to get to that point, because it took a lot of income growth to get to that point to where we could basically front load our 401ks, and IRAs, things like that. So individual stocks, oh man, that's a fun one, because I think it's way harder than people realize, and I think it takes a very very specific type of person to be able to probably outperform the market on a long-term basis. I think, I see a lot of retail investors that are constantly underperforming the market, and it kind of seems, it kind of feels like they're reaching too far, right? First off, I'm of the opinion that just market returns are usually great returns. There's nothing to be bummed about with, getting the S&P 500 average return over a long period of time. That is a huge wealth building opportunity. So to rely so heavily on individual stocks and try to get in the mindset of like, oh well, I have to beat the market. No, like you don't. You don't have to beat the market to accumulate wealth, right? You can simply invest in indexes long term and accumulate a lot of wealth. So when I look at individual stocks, I took time to kind of develop my valuation process, and I consumed various resources like Aswath Damodaran on YouTube, looking at valuation, looking at how the market tends to value companies here and there. And going from there, I've kind of like try to build like a lens at which I try to filter a lot of individual companies through. Now, if we want to, I don't know, I'll pull up Apple here for the kicks of it. So, hey, they've been on a nice run. Dang. All right, so I'll just pull up the automated template here and we'll kind of just go through it and see what I think the market's kind of valuing it at, what type of rate of return. And historically, I mean, especially recently, Apple has had a pretty big premium applied to it. I think it's one of those companies that has a huge amount of moat. People are going to buy their products. There's a lot of ways that Apple can increase probably revenue now with services, but we can see that it's gone through a lot of margin expansion, or not multiple expansion over the last 10 years or so. At one point it was trading, this is 2016, 2015. It was trading at like a free cash flow yield, EBIT yield, and net yield around like 8 to 10%. Now it's at 3.3% EBIT yield, 2.91% free cash flow yield. So, I mean, the market has applied a premium to this. And here's the thing, like if you thought Apple was expensive back here, right, and you had no index exposure, well, you just you missed out on probably years and years and years. Even if you thought it was expensive in 2018, you potentially missed out on years and years and years of the market rewarding it, giving it a higher premium, a higher multiple, and a lot of growth, and for what was pretty much the largest company in the index for a long time. So yeah. So, I mean, if I had to value it, like I think it does deserve a decent premium. I'm not going to give it a huge premium. Like their growth has kind of slowed. They're basically in low double-digit growth. I haven't looked at Apple a ton, but I would probably have to see like kind of analyst estimates, trying to figure out what they're kind of baking in and what I feel like the probability of those are, right? So if I just wanted to get like a 12.5% return, yeah, it's probably close to the base case scenario right now of let's see, bottom line growth 12%, assuming they got 12%. So like my investment philosophy is really, or individual stock analysis, has really shifted into just valuing cash flows, the stability of those cash flows, and then the risk that a company might have on the debt that they have, in regards to their balance sheet, and what type of risk that might give them. Oh, let's see, utility company in a way now. So, yeah, seriously. I mean, yeah. So there's a lot of times where I think like the market is, and this is probably my overall thoughts on the market, the equity market, S&P 500 VTI, is that the vast majority of the time the market's efficient. I don't think the market is super inefficient all the time, or even the majority of the time. I think most of the times the market is pretty efficient. And there's probably select times or select frequencies in different sectors where you can really accumulate something that's going to have long-term outperformance. It's going to happen. The market's not perfectly efficient at all, but it's also why I kind of believe, for myself personally, in a strong base of just index funds, because I want to make sure that like no matter what, I'm getting a piece of that growth, even if I don't believe that it's sustainable, or if I question it. There's a lot of people out there that are way smarter than me, making the market and setting the prices on these. I don't know if I ever would have believed that Nvidia would have gone up that much, right, that quick. And it sometimes it's in hindsight where you're like, oh yeah, now I see what the market is pricing in, and I'm agreeing with it, right? But if you miss the entire run up, well, what's the point? Right? If you have no exposure and you eventually come into agreement with the market and you're like, oh yeah, AI could be around for a long time and could have insane tailwinds for the next decade or two. Well, if you're in an index, you already had exposure to that, right? So what I've been doing really is just trying to keep my individual stock picks to a small portion. Well, not really a small portion, a small number of companies. Because realistically, I'm probably not going to be able to pick, let's say if my individual stock portfolio was like 40 names, right? Do I really think that I have a high probability of picking 40 names that are actually going to outperform the market? Not really. Um, and I think that there's probably a handful of companies, or maybe 10, 15, 20 companies, that I eventually see that I'm like, okay, this is good value and it might outperform the market. But I never want to put myself in a asset allocation position where um, I get jealous of the market going up, right? Like I want to be able to ride that wave. So when we look at, let's see, we go to portfolio tracker. So my portfolio allocation right now is about 65% ETI and SPY. So pretty much 65% index, 23.3% large cap, 2.36% mid cap, 2.3 small cap, about 3% REITs, and 4% cash. If we go into the individual stock breakdown, right, start to look at the individual stocks that make up of that portfolio. Obviously, the largest one is Meta. And this is the thing I would also say with specifically on individual stocks is that you're always learning and you can always do better. I could have done better on Meta. I could have not ever sold a single share. In hindsight, that would have been the thing to do, right? Not cut the position by like 50% after it went up like 100% or whatever, right? But it gives some validity to especially when you think the market's wrong and then the market starts agreeing with you, like you establish a position and then the market starts agreeing with you. That can be a hard thing to manage as far as the portfolio, the asset allocation in your portfolio, and how long you let that run. Honestly, with Meta, I think it was like I should have just let it run, like for sure. But what I've kind of come to realize and start practicing a little bit more is that I really want to like add into the ones that I have super high conviction and that have been reinforced by positive fundamental movements, positive business performance, but then also positive kind of market reactions, right? So if I'm right, I should probably continue to look for opportunities to add into the things that I'm right in, right? So, as you can see, I mean, it's the vast majority of my portfolio is in 1, 2, 3, 4, 5 names. Other than cash, I have my cash allocation here, which is about 12.8% of my individual stock bucket, and about 4%, 5% of my overall portfolio, including index funds. But yeah, that's kind of what I'm learning to kind of, I would say, try to just stay patient with things, and be very picky about when I'm greedy. Because I know people say like, oh, be fearful when the market is greedy and greedy when the market is fearful. But there's some people saying that you should be greedy right now. And they're talking about some like crapco that's down 90%, right? Probably shouldn't be super greedy right now if that's the case. Like, I think for me, I always want to try to be humble in my thought process. I never want to feel like I'm smarter than the market because I know I'm not. I know that there's probably going to be a few brief times in my life where opportunities are obvious and I can take advantage of those. And it's how I take advantage of those and execute on them, that is going to probably give me the ability to maybe outperform the index with the individual stock portfolio. Maybe. And at the same time, I have to be okay. I have to be okay being like, you know what, it might not happen and I might underperform. So, yeah, I think if you are not humble with individual stock picking and investing, um, eventually the market will humble you. Uh, it's just a matter of time. Um, although for some people, they're cocky and they short Nvidia with naked soul calls, and they're still cocky. So I don't know. There's that. Hopefully, but hopefully you're humble, right? Um, but yeah, that's something that I've tried to incorporate, is really being uh really questioning of like, okay, like, is the market really wrong, or am I just not saying something that I should be saying? Um, and eventually, if I have a high amount of confidence, then I should be able to act on that. Um, but I should also, if things play out, I should also be able to accept when I'm wrong, because I think some of the worst, losses happen when you don't accept that, hey, I was wrong. I need to cut this and I need to go somewhere else. Um, bag holding, averaging down when it's going to zero, that's not a good thing to do. And they'll absolutely wreck you. Um, but even like things, and this is something that in my own portfolio, like KRC has drastically underperformed this year. Drastically. I mean, if I had to pick a single stock that has, with the weighting that it has in my portfolio, KRC is down 23% year to date. 23%. I'm still up on it, because I bought it, around the 30s. So yeah, after dividends, I'm still up on it, but that has been a huge drag, especially when we're looking at like market beating potential. It's been a huge drag on my portfolio because it's about a 10% position that has if it's down 13% and the SPY is up 17%, that's what, a 40% deviation from the SPY. That's hard. That is hard. So it is easy. It is easy to be right on certain things and to still drastically underperform the market, or not come close to outperforming the market, because your asset allocations on your winners and your losers are just wrong. So the last said, yeah, individual stock investing is hard. It's hard to beat the market, right? It's very hard to beat the market. If you think it's easy, I don't know. I think there's always going to be segments of people that are in the right thing at the right time, that have market crushing returns. But to be able to do that over and over and over and over again, usually they're just fixated on that one sector or that one idea, right? They might be right for a little bit, but to be able to shift with the market and consistently find the things that are going to outperform over the next year, 2, 3 years, and to be able to manage that portfolio is very hard, very difficult. So really comes back to my investing philosophy is really grow your income as much as you can, control your spending, you know, take advantage of tax advantage accounts, invest, you know, your core holdings should always be just like, and for me, my core holding is always going to be like the S&P 500 or total stock market. And then I'm going to essentially pick individual stocks very, very, very selectively. Especially if I think for long-term plays, very selectively, and then try to admit when I'm wrong and cut my losers. And if I'm not wrong and I start getting confirmation on that, then let those things ride, and let them ride as long as I believe that, the thesis is playing out and I'm correct in it. Because those tail events where you get that company that compounds at 20-30% price for 10 years or whatever, that's what's going to carry your portfolio. So if you're trimming that constantly, in my mind, if I'm trimming that constantly, I'm just hampering my performance when I am right, and then taking that capital from something that the market has reinforced me being correct on and potentially putting it into something that is going to lag. But you can always de-risk. If you have a winner, you can always de-risk and just put that into index fund too, which I might be doing that. If my individual stock portfolio gets to a certain point, I'll probably cut a chunk of it and just put it back into VTI or SPY if I think the full, long-term value has been like realized, just to control that asset allocation before them. So, with that, if you guys have any questions, put them in the chat. I don't really see too much. How's it going, Fake Alias? How you doing, man? Andrew, yeah, I can't wait to listen later. Warming out? Oh, you're probably working out. SSH, yo, what's going on, man? How's it going? Yeah, cool. Well, I'm not gonna leave a long awkward silence. So if nobody has anything, I hope you guys had a great day. Hope you guys have had a great, couple months or whatever. It's been a great year for the market. It's been good. So hope you guys are doing well, and we will catch you in the next one. Peace.